The S&P 500 is a group of the 500 largest companies in the stock market. This is not you going out and trying to find the next Amazon, the next Nvidia, the next Apple, the next Tesla, because that's more risky. And a lot of people try to do that without actually understanding the risks and without actually understanding what the heck they're investing in. So you want to understand now, what is the game that you want to play? Do you want to actually be an investor, or do you just want to try to chase a hot return? It's kind of like when you think about sports betting. Why do people get so attracted to sports betting or any sort of gambling? Because the whole idea is if I invest $100, I could potentially win $500, $1,000, $3,000, depending on whatever is going on in the game. Investing is not like that. Real investing is not taking $100 and then turning it into $500 in 6 months. That's not investing. Investing is taking less risk, but working to strategically grow that money year after year after year, decade after decade after decade, and consistently working to see that money grow. It's less exciting, less attractive, but you can actually build strategic wealth when in gambling, the house always wins. So if we talk about the S&P 500, what we know is that over the last 100 years, the stock market, the S&P 500, has grown by an average of 10% a year. Does that mean that the stock market always goes up? No. We've seen the stock market fall, we've seen market crashes, we've seen recessions, we've also seen market booms. But on average, we have seen the stock market, the S&P 500, rise by around 10% a year. If you wanted to just invest into something like the S&P 500, there are funds that give you exposure to that. That way you don't have to go out and buy all 500 of those companies and then manage your portfolio. I'm going to give you a couple examples. I'm not telling you what to invest in. For example, there's a fund called SPY, SPY. If you buy one share of this ETF, this fund called SPY, you can do it on pretty much any stock brokerage, you're getting exposure to the S&P 500. So if you buy one share of this, you're buying a little piece of the 500 largest companies in the stock market. If one of the companies, let's say Tesla, were to go bankrupt, it will get kicked out of the S&P 500 and be replaced by another stock, and you wouldn't have to do anything. It's automatic because you own a piece of that fund. This is one way to invest your money, and the way you win here is through what I call ABB, always be buying. You buy when markets are low, you buy when markets are high, you buy when markets are sideways, you buy when it's raining, you buy when it's sunny outside, you buy no matter who's in the White House, you're always buying because the A in ABB is always be buying. And you set up an automatic system where every week, or every 2 weeks, or every month, you pick the cadence, you're buying more. Doesn't matter what's happening, you just keep buying no matter what. Everyone always comes up with some sort of funny fairy tale story. Well, what if this, and this happens? Should I still buy? ABB means always be buying. You keep buying no matter what for weeks, months, decades. That's how you win. Now, some of you might say, well, Jaspreet, that's cool and all, but I also like studying companies. I also like studying financials. I also like listening to earnings calls and reading financial statements because, well, that's what I like. If you want to do that, well, that comes with more risk, more potential return. The key is potential return. Not guaranteed to get more returns, but it's potential. This is where now you can look into more niche opportunities. You try to find more niche companies, more opportunities there. Maybe you try to find the next Tesla, the next Amazon, the next Nvidia, because now you're actually digging into the research. You're looking into market shifts. You're looking into understanding, well, what is changing in the economy that I can invest in something that a lot of people are overlooking. This is cool. I have no problem with you doing that. The mistake that I see so many people make is they say, I want to be a long-term investor. I want to find the next big thing. Okay, cool. Then you start doing some digging on the internet. You come across some post on Reddit which says you need to buy this stock. Then you say, oh, that sounds cool because some random person on the internet says so. You go and buy it, and then the stock starts to go down after 2 weeks. And now you panic and you sell because you're worried that you're going to lose all of your money. See, there's a lot of things that went wrong here. Number one is you didn't actually do any research. You have to actually, number one, understand the shift. Why is this industry getting better? And then you have to analyze the company. Why is this a good company inside of this shift? If you say, I want to invest in data center companies because data centers are growing because of artificial intelligence, all right, cool. Well, now you have to actually analyze the companies. There's a lot of different data center companies out there. There's a lot of different ways to play data centers. You could take a look at the energy companies that are providing energy to data centers. You could look into the real estate companies that own those data centers. You could look into the management companies that are managing those data centers. There's a lot of different ways to play it, but then you have to analyze the companies, look at their financials. Does this company have more assets than liabilities? Is this company's revenues growing? Are their profits growing? These are the types of analysis that you want to do. And then you want to actually be an investor, which is not get caught up in the emotions, because as somebody who owns a media company, what I can tell you is a lot of the traditional media is in the business of selling you hype because they just want to get clicks because that's how they get paid. And that emotion is what drives a lot of people to buy or sell when they shouldn't be. And so if you want to be an investor, remember, the goal is to be an investor, not get caught up in the emotions, because emotions are the enemy of profits. Now that we've covered how do you invest your money, let's also talk about now how do you spend your money smartly, which is one of those things that everyone thinks is so simple, but if it was so simple, why are so many people living broke, in debt, with no idea of how to build wealth? Because the reality is, what you want to do now is, number one, live within your means. And the mistake that a lot of people make is they assume that when I go out to buy a phone, I want to buy a $1,000 phone, that means I can afford the $50 a month payments. But that's very different from somebody who can actually afford the phone. Because in my mind, if I want to afford a $1,000 phone, that means I can afford that phone in cash without having to worry about the money. The whole $1,000 without having to worry about the money. In fact, for me, it's a little bit stricter. What I do is I follow a rule of 5, which is especially for luxuries, things that I don't need. That is, if I can't buy 5 of them, I can't afford 1 of them. Now you can start to see a different game. I'm not going there trying to worry about the payments. I'm going to try to actually buy the thing without having to worry about the payments. Because I don't want payments. Because those payments are making the banker richer. Especially when that thing is not putting any money in my pocket. If you're talking about buying a rental property, buying a business, then sure, it's a completely different discussion when it comes to debt. But let's not talk about that right now. We're talking about general liabilities. A lot of people are financing their clothes nowadays because you got buy now, pay later, or as I like to call it, broke now, poor later. And this is a game where it's very easy to finance whatever the heck you want. But if you want to build wealth, you can't keep making your banker richer to finance things that are making you broker. You have to use your money smartly. That means, number one, spend only what you're allowed to and stop financing things that are not paying you, which includes your car. Stop financing your car. Financing your car is a triple whammy. You're paying interest on something, whammy number 1, that is a depreciating liability, whammy number 2, which also has a limited time span, whammy number 3. Because that car is not going to last you forever. It's going to last you 5 years, 10 years, 15 years, maybe 20 years. If you're lucky, you got a nice Toyota. Well, eventually that car is not going to keep running. You're going to need another car. So when you're buying that car, treat it like a liability because it is losing value. And this means maybe you don't buy as nice of things right now. But the goal is for you to be able to buy whatever you want because of your investments and never have to worry about the price again. See, my goal for you isn't to live small for the rest of your life. It's for you to make a sacrifice for a period of your life. That way you can spend the rest of your life never having to worry about money again. But in order for you to do that, you can't keep doing what the majority of people do, because the majority of people are broke, they retire broke, and they never ever have a chance to build wealth. You can't keep living like that if you want to live a life of actual wealth, and it starts with you using your paycheck the right way. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.